Hello and welcome to South Australia's only online monthly property report. No adverts or brand push, just helpful information, forecasts and tips for people working in or interested in real estate. In the next few minutes we'll answer the question, how's the December market? And then what's this mean for you? Before moving on to a few tips on how to take advantage of the latest market conditions. But first, in response to some emails, I'd like to highlight that this report is exclusively on the South Australian real estate market and that it's important to look at your state's local market conditions independent from the general media reports on the national property market or on other states' market conditions before making a property decision. But a little bit more on that later. First, let's recap last quarter's year-to-year results. In comparison to the same time last year, the median price for South Australian country houses increased by 9%. Metropolitan houses increased by 6.7% and metropolitan unit prices increased by 7.9%. Overall, South Australian median house prices increased by 7.2% and now stand at $370,000. In regard to rental vacancy rate, a 3% vacancy rate is seen as balanced. So anything less than 3% is seen as a market where demand is exceeding supply. As such, South Australia's current 0.9% vacancy rate represents a very high demand rental market. Interest rates remained on hold this month and are forecasted by analysts to remain unchanged until at least April next year. Leading economists share a common view that the economy is performing well overall, and as such, rate rises into the new year should be small, few and far between, with 2 or 3 small increases expected after April. As indicated last month, the rampant price growth we've had in South Australia from late 2009 to early 2010 has slowed in July, August and September to the extent that property prices actually dipped by 2.6%. The main reason for this has been a large influx of new properties onto the market over that period. Over the last 5 weeks, this flow has increased to a recent 3-year high and further softened pricing and to some degree the amount of time the average property is on the market, but not to an alarming level. This is not particularly unusual as every year on average, sunny September is the month when the highest number of new properties come onto the market. This can sometimes have the consequent effect of slowing price growth in the September quarter as supply rises to meet demand. For example, over the last 40 quarters in South Australia, that's 10 years, we've only seen 4 quarters where state median house prices have decreased, and 3 of them were in the September quarter. But in almost every case, prices recovered completely and in fact grew in the following quarter. However, we do anticipate a further slight price drop to show up for this November and December sales results due primarily to the hit in consumer confidence caused by the Reserve Bank and major bank interest rate rises. But before the media crank up the bad news sells bandwagon and doomsayers jump on board, let's put it in perspective. When we talk about a price drop in the South Australian market, we're usually talking about a price drop over 3 months of only about 1 to 4%. At this low level of price fluctuation, most sellers are generally not overly affected and people still secure good prices for their property on average. Australia is one of the most insulated economies in the world and South Australia is one of the most insulated state economies in Australia. Not surprisingly then, South Australia continues to have the most stable property market in Australia. However, the market has changed. In just a few weeks, it has gone from a robust seller's market to an almost balanced market, slightly favouring buyers. Sellers who do well over periods such as the one we're in now are usually those who recognise the critical importance of listening to their agent and acting quickly on the advice that's given, particularly when prices start to stall or even fall around their property as market conditions change. The basic rules in sales are it's the seller who sets the asking price, but it's the buyer who sets the sale price. The higher a property is priced above realistic market value, the fewer the number of buyers willing to consider it. If the market changes, you need to change with it. To ignore the market conditions can cost you a great sale. For example, studies have shown that if a well-marketed property is 10% over market value, it will only appeal to just 30% of buyers looking for a property of that style and location. If the same property is just 5% over market value, it would appeal to 50% of buyers. But if it is priced fairly at current market value, it will appeal to 95% of buyers. An agent can't negotiate when they have no inquiries, so it's critical to get the price right and ensure it is adjusted to meet market conditions as soon as possible. Now, a couple of strong words of warning in relation to this advice. The first one is, do not engage in bait pricing. This is where an agent intentionally markets your property at a completely inappropriate price far below fair market value in order to draw buyers who would not be prepared to pay even the lowest extreme of your real price when it's disclosed. Bait pricing is illegal, unprofessional, and can result in large fines for the agent and substantial costs for the property owner. Second thing is, ensure your agent gives you tangible examples of their activity and marketing before you make a decision to change your price. Most agents are excellent, but there are a small element who push for quick, unsubstantiated price reductions to get a quick sale that they need, usually to offset low fees. This is what we call low margin, high volume sales. Like my accountant, a good agent will tell you what you need to hear, not what you want to hear. And a quick word of advice to buyers, particularly in the current market. When making an offer, make a fair one. Some buyers make very unrealistic or even what could be called rudely low offers in a balanced or buyer-friendly market. In almost all situations, this is counterproductive in a negotiation, and rather than create a starting point for a discussion, it results in this discussion never getting started. People selling their property are, like buyers, normally quite highly stressed, but they've also got the additional emotional attachment to what is normally a loved home that has been part of their life. Reasons for sale can include illness, health, marital problems, moving interstate, finance, and a whole range of other things. A low, unrealistic offer embarrasses the sales professional who has to present it, antagonises the owner, and sets the scene for hostile negotiations with no room for concessions or inclusions. So make your offer fair. Ask yourself, how much do I really want this property? Would I be upset if I lost it for the sake of $10,000 or $1,000 or $100? If the answer is yes, then I suggest it's worth considering putting your best offer in first and avoiding disappointment. Well, that's the indicative SA market summary for now. If there's anything you'd like to know, please don't hesitate to contact me via Twitter at rhSA_CEO or by email at kevinm@rhsa.com.au. Thanks for tuning in. Until we catch up again, from everybody at Rain & Horn South Australia and myself, I'd like to wish you and your loved ones a happy and safe Christmas and a fantastic New Year.